Hello students, welcome to the lecture series of Patagala College of Commerce and Management. Today we are going to learn financial services and this topic is taken from SYBBI Financial Markets. Today we are going to cover meaning of financial services, types of financial services and fund-based financial services. Let us understand the meaning of financial services. Financial services refers to services provided by banks and financial institutions in a financial system. In general, all types of activities which are of financial nature may be regarded as financial services. In a broad sense, the term financial services means mobilization and allocation of savings. Thus, it includes all activities involved in the transformation of savings into investment. Financial services play an important role in the development of the economy. Basic financial services provided are banking, insurance, mutual funds, leasing, factoring, merchant banking, etc. The financial services can be divided into two parts: fund based financial services and fee based financial services. Let us understand fund based financial services. These services are related to fund transfer from one place to another place and from one person to another person. The fund based finance in banks is in different forms. The facilities like overdraft, cash credit, bill finance, demand loans, term loans, etc., wherein immediate flow of funds available to the borrower, that is known as fund based facility. Let us understand fee based financial services. Today, the customers are not satisfied with the mere provision of finance. They expect more from financial service companies. Hence, financial service companies or financial intermediaries provide service on the basis of non-fund activities also. Such services are known as fee-based services. The non-fund based services like issuance of letter of credit, merchant banking, stock broking, credit rating, wherein the banks get fees as income and there is no immediate outflow of funds from a bank. The important fund based services which we are going to discuss are leasing, hire purchase, bill discounting, venture capital, housing finance, factoring, and forfeiting. Let us understand the meaning of leasing. A lease is a contract whereby the owner of an asset, that is the leaser, grants to another person, the leasee, exclusive right to use the asset for an agreed period of time in return for a payment of a rent called lease rental. Capital assets like land, building, equipments, machinery, vehicles are the usual assets that are generally acquired as a lease basis. At the end of the lease period, the equipment is returned back to the leaser or it is further renewed. The leasee has a possession and can use the asset on payment of a specific rentals over a predetermined period. Let us understand hire purchase. Hire purchase is a method of acquiring a capital asset for use without paying its price immediately. Under a hire purchase arrangement, goods are let on hire. The hirer, that is the user, is allowed to pay the purchase price in installments and enjoys an option to purchase the goods after all the installments have been paid. A hire purchase agreement is a kind of transaction in which goods are let on hire with an option to the hirer to purchase the goods by paying all the installments. The goods are delivered to the hirer at the time of contract and the ownership in goods passes to the hirer on the payment of the last installment. Each installment is treated as hire charge. If there is a default in payment of installment, the seller is entitled to take away the goods from the hirer. Thus, hire purchase agreement has to bailment of goods and element of sale, though the option of purchase goods is allowed in the very beginning. Thus, the property in the asset remains vested in the seller till the right of purchase is exercised by the hirer after making payment of all the installments. Now let us understand bill discounting. Bill discounting is an attractive fund-based financial service provided by the financial companies. In the event of time bill which are payable after a specified period, the holder need not wait till maturity or the due date. If he is in need of money, he can discount the bill with his banker. After subtracting a certain amount, that is the discount, the banker credits the net amount in the customer's account. Thus, the bank purchases the bill and credits the customer's account with the amount of the bill less the discount. On the outstanding date, the drawee makes the payment to the banker, and if the drawee fails to make the payment, the banker will mend the amount from the customer who has discounted the bill. So in other words, the discounting of bill means giving loan on the basis of the security of bill of exchange. Let us understand the concept of venture capital. Venture capital funds provide funds to new and promising companies that are typically knowledge based, assume a high risk element, but promise substantial growth and higher rewards. Venture capital is also known as risk capital, in which capital that is invested in a project where there is a substantial element of risk relating to future creation of profits and cash flows. Risk capital is invested as shares, equity rather than as loan, and the investor requires a higher rate of return to reimburse him from his risk. It does not just make an equity participation in a company, but also assists in the management and functioning of the company by rendering its expertise to the business. It is a long-term investment in growth-oriented small or medium firm. Venture capital financing involves high risk return spectrum. The returns in venture financing are essentially through capital gains at a time of exits from disinvestment in the capital market. The venture capital in India is of recent origin. They are sponsored by financial institutions, banks, private sector, and overseas financial institutions. Let us now understand what is housing finance. Housing finance, purely mentioned to provide finance for house building. It appeared as a fund-based financial service in India in 1988 with the establishment of the National Housing Bank by the RBI. The National Housing Bank is an apex housing finance institution in the country. As of now, a number of specialized financial institution companies have entered the field of housing finance. Some of the other housing finance institutions are HDFC, LIC Housing Finance, City Home, etc. Let us understand the next fund-based service, that is factoring. Factoring in finance is a source of immediate capital. Factoring involves three parties: a factor, a client, and a debtor. The factor is the financial institution that provides finance to the firm in exchange for receivables. The client is the firm that sells its receivables. The debtor is the party who owes the trade debt. The debtor therefore ends up paying the factor instead of the original business. Hence, it is a financial arrangement between the financial institution, that is a factor, and a firm, that is a client. A factor purchases the trade debts or receivable from the client at a discounted price. The next fund-based financial service is forfeiting. Now, forfeiting is a method of financing of receivables relating to international trade. Forfeiting is a financing and risk management tool available to the exporters. So in case of international trade, an exporter relinquishes his right to the receivables due to him at a future date in returns of immediate cash payment. The exporter discounts the export receivables with the forfeiter and surrender his rights to claim payment from the importer. Thus, forfeiting enables the exporter to convert his credit sales into cash by discounting his receivable with the forfeiter. In an export transaction, there are several risks involved. The risk of non-payment by the importer due to insolvency, interest rate risk, exchange rate risk, and the country risk or political risk are the usual types of risk faced by the exporter. So, through forfeiting, the exporter is relieved of risk of international trade. Students, now let us do a quick recap of what we did in this session. We did the meaning of financial services. Now, what are financial services? Financial services are those services which are offered by banks and other financial institutions. The financial services can be divided into two parts, the fund-based financial services and fee-based financial services. Fund-based financial services are those services where a lump sum amount is lended by the financial institutions or the banks to the borrower. A fee-based financial service are the services where the banks and the financial institutions offer certain services to the firms in returns of certain fees. Now, what are the different fund-based services we learned in this lecture? The first is leasing, the second was hire purchase, the third was bill discounting, the next was venture capital, then housing finance, factoring, and the last was forfeiting. I hope that you have understood financial services. That's all in this session. Thank you, students.